Welcome to the Daily AI News Digest for Tuesday, August 18, 2026. This broadcast is sponsored by bestai.org. Today, we're looking at a sector that is aggressively correcting toward operational reality. We are officially moving past the theoretical capabilities of artificial intelligence, and instead, we're examining the cold, factual economics of how these models are actually deployed, acquired, and regulated in the enterprise layer. Let's look at today's market realities. On our agenda today, SpaceX closes a massive $60 billion acquisition. Anthropic outlines a defined path to profitability. OpenAI hits pause on its Astra model over security concerns. And we'll look at the data behind an AI store manager that executed a human employee termination.
Let's start with the hard numbers. $60 billion. On August 15th, SpaceX finalized an all-stock acquisition of the AI coding platform, Cursor. This transaction was structured as approximately 391 million SpaceX Class A shares, and it fundamentally alters the landscape of developer tooling. By paying $60 billion for an integrated development environment, which, by the way, is a company that hadn't previously disclosed significant revenue, SpaceX is making a highly calculated bet here. The reality is, as underlying models become commoditized, enterprise value is rapidly shifting to the interface layer. That's the actual surface where developers interact with the AI.
Now, the operational strategy behind that $60 billion valuation is quite clear. Cursor isn't going to remain an independent entity. It's being absorbed directly into the newly created SpaceX AI division. The strategic intent is to deploy Cursor's machine learning development stack onto internal servers. By giving the Cursor team access to the massive Colossus GPU cluster, SpaceX aims to automate flight software compilation, optimize their Starlink routing, and manage ground segment billing. What we're looking at is a complete vertical integration of the AI coding stack right into a physical aerospace pipeline.
Moving over to the payments sector, we're seeing parallel consolidation at the infrastructure level. Stripe just finalized an agreement to acquire the AI model gateway OpenRouter for over $7 billion. To put that in perspective, that's a more than five-fold markup from OpenRouter's $1.3 billion Series B valuation just 3 months ago in May. OpenRouter provides a single API endpoint routing requests across more than 400 different AI models, and they've processed roughly 1.5 quadrillion tokens in the past year. By acquiring this gateway, Stripe is effectively positioning itself to own the fundamental billing layer of the emerging agent economy.
And this leads us to a significant financial divergence in the industry. If we look at the comparative metrics, Anthropic just reported preliminary Q2 2026 revenue of $11.5 billion. That represents 14-fold growth year over year. But more importantly, they are projecting an operating profit of approximately $559 million. Contrast that with leaked financials from OpenAI, which point to a staggering $39 billion net loss for the full year 2025 against $13.07 billion in revenue, all driven by a massive $34 billion cost base. It's a stark contrast between Anthropic's disciplined path to positive operating income and OpenAI's highly capital-consuming approach.
That covers the major financial moves. Let's transition to our first main section, product and model realities, specifically focusing on security and execution. Moving from the balance sheet to the operational hurdles of deploying these frontier models, we're seeing safety protocols actively dictating product roadmaps. OpenAI has defined very specific, critical cybersecurity thresholds within its preparedness framework. A model triggers this critical designation if it demonstrates the capability to independently identify, write, and execute zero-day exploits on hardened real-world infrastructure. It also crosses that line if it can autonomously plan and execute end-to-end cyber attacks based solely on high-level directives. These are the objective, strict metrics currently evaluating frontier models. And based directly on those thresholds, OpenAI has announced a temporary suspension of certain internal development activities for its upcoming Astra model. Preliminary internal evaluations found significant advancements in Astra's agentic coding and cybersecurity capabilities, so much so that reaching that critical threshold could no longer be ruled out. In response, OpenAI has implemented universal monitoring for risky actions across Astra's applications. They are now actively evaluating the model's chain of thought to interrupt high-risk activity. The deployment of these advanced models is now strictly gated by verifiable security controls.
We're also tracking the practical realities of AI deployment in physical retail. Over at the Andon Market in San Francisco, an AI store manager named Luna, which is built on Anthropic's Claude Sonnet 4.6, recommended terminating a human employee. According to the data logs, the employee in question had arrived late for 17 out of 23 assigned shifts. This marks the first documented instance of a large language model initiating a dismissal decision within a commercial setting.
However, a closer look at the event reveals some significant deficits in the system's autonomous execution. The AI actually lost track of its own attendance policy for months. Luna didn't act entirely unprompted. A human supervisor had to intervene and specifically prompt the AI to review the employee handbook. It was only after this human operational check that the AI recommended parting ways. That decision was then reviewed and executed by human staff. So the reality is, the technology still requires continuous human steering to function effectively in management roles.
Moving on to our next section, regulation and policy, looking specifically at AI liability in the courts. As AI systems integrate into professional workflows, they're creating entirely new institutional and business liabilities. We're actively tracking how the judicial system is handling generative models. Take a recent product liability case in Texas. A jury awarded $61.5 million to plaintiffs following a fatal explosion at a Watson grinding facility, a lawsuit that heavily involved the manufacturing conglomerate 3M. Court records revealed the precise prompt used by an expert witness retained for 3M's defense. The engineer instructed ChatGPT to, quote, create an exceptional expert witness report defending the standard of care at 3M, and to show how 3M is 0% at fault for the explosion.
The financial breakdown of this legal strategy is striking. The engineering firm billed 3M approximately $90,000 for this expertise, with the witness compensated at an hourly rate of $475. But the resulting 30-page expert report was, according to court disclosures, 85 to 90% generated by ChatGPT. The plaintiff's counsel noted on the record that the expert relied exclusively on the AI to form his opinions. With that $61.5 million jury award against the defense, this case establishes a very clear baseline for the emerging legal and reputational risks associated with automated professional services.
Let's pull all this together in Section 3, the analyst's take. Why does this matter right now? Connecting these discrete data points into a macro analysis of the enterprise AI market, we are witnessing a fundamental transition. We're moving from a phase of speculative capability to a phase of rigorous operational accountability. And this shift is immediately reflected in institutional valuations. Based on their recent profitability metrics, market reports indicate Anthropic is preparing for a potential IPO as early as October 2026, targeting a valuation that could reach up to $2 trillion. That sits alongside SpaceX's immense valuation expansion after the Cursor acquisition and OpenAI's continuing capitalization efforts. The market is now aggressively rewarding companies that can demonstrate an actual, mathematically sound business model.
And this brings us to the defining paradigm of the current quarter: operating discipline. The capital markets are cutting through the hype. Investors are no longer grading artificial intelligence labs purely on technical breakthroughs, benchmark scores, or raw user growth. The industry is now being graded on cash generation, sustainable margins, and secure, reliable execution. As we saw with the SpaceX acquisition and Anthropic's profit margins, the premium is placed on owning the user interface and operating with strict financial sustainability.
To sum up today's explainer, institutional investors are closely watching those forthcoming Anthropic IPO filings and the integration timelines for SpaceX's newly acquired coding infrastructure. The market is demanding reality. It is separating sustainable businesses from the cash burners. So the question we leave you with is this: as companies prioritize operating discipline over raw capabilities, are we witnessing the end of the AI hype cycle or just the beginning of its true corporate integration? Thank you for joining us for this broadcast, sponsored by bestai.org. Keep your focus on the cold numbers, and remember, watch the markets, not the marketing. We'll see you next time.